Hi, everyone. I wanted to take a few minutes to go over the example that is in your book on pages 176, 177, related to valuing stock using free cash flows. We'll be talking more about free cash flows as we go through the rest of our semester here, but how you can think of free cash flows is just the cash the company has for the investors. Okay, so what we do is we use this to try to value or determine a value of what the stock should be selling at. So the example in your book, I think if I walk you through it and explain it, it might make more sense to you. So we have here global harmonic control systems. Revenues, which are forecasted to be 500 million in 1 year, are expected to grow at 10% for the 2 years after that. So if you notice here, we have a little income statement that we have revenues, and then we have revenues growing at 10%. So that's 500 times 1.10, and then the 550 times 1.10. Then they'll grow at 8% per year for the next 2 years. So now we're multiplying year 3 by 1.08, and then year 4 by 1.08. And then they tell us there'll be 6% per year after that time. So for infinity. Expenses, excluding depreciation, are 60% of revenues. So we're not going to put any kind of depreciation component in our analysis here because it has nothing to do with cash. So we only want to subtract expenses related to cash, and they're all at 60% of our revenues for that particular year. So 60% of 500 would be 300, 60% of 550, 60% of 605 would be the 363, etc. Net investment, including net working capital and capital spending less depreciation, is 10% of revenue. So that's how much the company will be spending in cash for those items. So net investment includes net working capital and capital spending less depreciation. We're trying to isolate here how cash will flow during these periods of time. So if we continue our analysis here, we take our revenues minus cash expenses. Earnings before taxes will be $200 for the first year. Now, remember, we do have an income tax component. 21% is the current tax rate for real in the United States for corporations, and that's the assumption here. So subtract that to get your cash from earnings. Now, subtract any investment money you have to pay, and that's subtracting. So when you're investing, you're paying more money out. So how much cash is available after all of those items are accounted for? Well, and this is in millions, so that you know, this is $108 million. We just keep the dollar amount small so it's easier to work with. But picture that as 108 million. We do that same computation for year 2. So net investment, by the way, is 10% of revenue for each year. So 10% of that year's revenue. And you can see the calculation there. So again, in year 2, we assume the tax rate will stay the same because we don't know any better at this point. So our taxes will be 21% of 220. You get the 4620, subtract that, and then subtract the investment for that year, 118.80. So 118,800,000. We would do that same computation for year 3, 4, and 5 because they change differently. There is not a constant change here as of yet. It happens after year 5. After year 5, it grows 6% per year, and all those calculations will remain the same. And those are the assumptions here. They are an all equity firm. So that means they're fully funded with equity. 12 million shares are outstanding. The discount rate of 6% is appropriate for a firm of this risk. Now, the first step in calculating value of the stock using free cash flow. Now, net cash flow is our free cash flow here. Let's take a look at what year 6 will be. And we really should have that column there. It would say 6 and thereafter. So you can add that in. Because net cash flow grows at 6% per year after year 5, it will be forecasted to be the 152.43 times 6%, or 1.06. So the free cash flow from year 6 going forward will be 161.57. So you use the free cash flow from the end of year 5 to forecast that. Now, since this is a growing perpetuity, it's going to grow at 6% forever. We can calculate the value of that growing perpetuity as of the end of year 5. And that would be the end of year 6, 161.57, divided by the discount rate minus the growth rate. We learned that back in last chapter, even the chapter before. Growing perpetuity. See how these chapters are coming back. So that is the value at the end of year 5. So we can call that the present value as of the end of year 5. Well, we're not trying to figure out the value of the stock at the end of year 5. We're trying to figure out the value of the stock at the beginning of year 1. So now we have to take that growing perpetuity calculation. That's the only part we're calculating right here for that free cash flow. We'll deal with years 1 through 5 in a second. But we're going to take that 1,615.71 million, excuse me, and now discount it back to present value. And that's a simple present value calculation you learned in chapter 4. I know I say simple and you're going, yeah, right, lady, right? But remember what the formula is. We take the future value and multiply it, or you could think of it as dividing it by 1 plus the discount rate to the number of periods power. And that will give us the present value of that growing perpetuity. Remember, we always have to bring it back to time 0, the beginning of year 1. And that's what we did, but we only did that portion. Since the company grows at different rates in years 1 through 5, we have to calculate the present value for each year separately. And that's our next step. So the present value of the cash flows during the first 5 years is, well, take the 108 free cash flow, divide that by 1 plus the discount rate to the first power, because that's the end of year 1's value. We need times 0. The end of year 2's value is 118.8. So we have to divide that by 1 plus the discount rate to the second power, because that value is as of the end of the second period. We need the value as of the first. The third period, 130.68, divide that by 1 plus the discount rate to the third power, because we need to bring it back 3 years. Fourth one, we need to bring that one back 4 years, and then the fifth one. So these separate calculations will give us the present value of those future cash flows, the net cash flows, to the end of year 1, 2, 3, 4, and 5. So once you do those calculations and add up the results, the present value of the first 5 years is 415.63. Add those first 5 years to the growing perpetuity present value you determined in step 1, and that gives you the total value of the firm today. It would be $1,184 $12,890,000. Now, divide that by the number of shares of stock. Well, if we look at that as in millions, 1,184.89 million divided by 12, not because there's 12 shares of stock, but there's 12 million shares of stock. We can assume the price per share, $98.74 today, using the future cash flows that are expected for the life of the firm. Now remember, the above calculation assumes a growing perpetuity after year 5. So that's one way of valuing it, using cash flows. However, as the author has pointed out, that stocks are often valued by multiples. So another way of estimating this value of the company is via a multiple rather than a growing perpetuity, like the price earnings ratio. So if the company's or the industry's price earnings ratio is 7, so for every dollar of earnings, it's valued 7 times in the market. Because earnings after tax in year 5, and that's what we're focused on here, earnings after tax up here, $222.99. You don't take investments into, because that has nothing to do with price earnings ratio. We could then take 222.99 times the PE multiple of 7, and the value of the firm would be estimated at 1,560.95. But that's at the end of year 5. So that's just the value at the end of year 5. Still need to determine the present value of years 1 through 4, and then add 5 also. So in this bottom calculation, you're still doing the same steps you did above to determine the present value of those first 4 years. But in year 5, instead of finding a growing perpetuity present value, you're going to find the present value of what the firm is estimated to be at the end of year 5 by adding that estimate to the cash flow and then bringing it back to present value. So in this method, and bringing it back to present value, I just mean divide it by 1.16 to the 5th power. So in this way of determining that value of the stock today, you would take that total, which is in millions, and divide it by the 12 million shares. And in this instance, you would get very close to what the other method shows, a little bit less, 96.57. So now we have 2 estimates of the value of the shares in the equity. Remember, these are estimates. The different estimates reflect different ways of calculating this value. So you can use the constant growth discounted cash flow method for terminal value. And in that case, our estimate per share would be 98.74. Using the PE comparable method, 96.57. There is no best method. We just need to be familiar with both. Okay, so that's what we're trying to get across here. So in your practice, you may need to do both. One, okay, you need to be familiar with both. And the reason we use this is because the dividend model we used in the beginning of the chapter may not apply to this company because they may not pay dividends. So how do we figure out or estimate its value? We use its cash flow. Okay, so hopefully that makes it, wrap your head around it a little more. Please continue posting your questions on the discussion board.